Welcome back to another episode of Reinventing Finance. As usual, I have the pleasure of not doing this all by myself. So I have my lovely co-host with me. Ron, how are you today?
Very, very fine, and super looking forward to our guest today. We have,
And and who that is, Ron? Why don't you lead us to
hey, you,
it?
you see, I'm all excited already. I mean, this has all been building up to this right now. Jeff, it's a pleasure to have you on the podcast. Having spent quite some years in M&A myself, I'm super enthusiastic to learn from you about warranty and indemnity insurance, but please, could you briefly introduce yourself, Talos, your company, what you're doing there?
Sure. Thanks for having giving me the opportunity to be on, guys. I appreciate it. In terms of my career, I started as an underwriter in 2005. I've been extensively involved in W&I tax and contingency products outside of North America on a global basis. So it's really given me a front row seat and a role in the transactional risk market from the very early days to what the market is today, a reasonably mature global market. Talos is an MGA that was co-founded by Anish Varma, a well-respected tech entrepreneur, and myself in 2024. Prior to meeting Anish, I wanted to build a commercial multi-line MGA using W&I as a wedge. Anish was a frustrated purchaser of insurance, having started off a few previous ventures over the years, and he was keen to introduce technology into insurance with the aim of ensuring better customer outcomes. We came together around this idea of a tech-enabled multi-line MGA. In late 2024, we secured our initial 10 million of insurance capacity as well as VC funding. That initial 10 million of capacity is now 20 million, and that's across 5 insurance partners. Currently, we're a team of 12, 4 on the underwriting side and 8 engineers. We're also growing. As I mentioned, we were initially focused on W&I, but in keeping with our ambitions to be a multi-line MGA, we've hired a second team of underwriters to help with our second product line. And I guess just to round off the point, at our core, Talos is a group of very, very keen builders in the tech and the insurance space. We're excited about our plans, and we're very, very appreciative of the positive response we've had from the market thus far.
So let's dig a little bit into I think unless you feel that contingency and or other contingent tax is helpful for understanding the complexity, but maybe just W&I. So why is that valuable in an M&A deal? I thought that's what you pay the DD consultants for, uh, to make sure that they dig up the dirt and no one is liable for an investment go wrong.
They're also called lawyers, Nick, right?
Sure,
Attorneys, not
lawyers as
BD
well, but
consultants. I feel a little bit offended here, but
you're both.
Yeah, there are really two main drivers in terms of the value proposition for W&I. The first is what is commonly called a clean exit, right? So in most M&A transactions, a seller would be required to leave some money, a pot of cash behind in some sort of escrow account for a number of years. With W&I in place, what typically happens, outside of North America, certainly, is the seller is able to cap their liability at £1, and therefore it gives them a clean exit, and they are not required to leave that money behind. And also, the second real value driver, I would say, is it removes a point of contention or an area where there could be friction in the negotiation process, and that's around the seller indemnification obligation. So I think those two are really, really the main drivers of the value proposition.
Who usually pays for the insurance premium?
It depends. Whoever
Okay,
has the upper hand in the negotiation, it could be the
doesn't.
seller, it could be the buyer, it could be split. But it's one of those things that really it's a point of negotiation that the parties come to a conclusion. I'm usually not in the room for that, so I don't technically know, but that's usually how it's done.
Okay. And what would be some reasons for considering but not buying it, other than, I don't know, the price, I guess. But
Yeah, no, the reason for really not buying it, I mean, it's sort of they're twofold, right? One is sort of insufficient product awareness, right? Because if you asked me, if you said if you were an entrepreneur and you could leave behind, or your choice was to buy an insurance policy for 50 grand and not leave $1 million behind for 2-3 years versus leaving that behind, I think that choice is quite obvious. And I think any sort of buyer, or any of the parties that I've ever come across sort of see that value proposition. So I would say the reason people would not buy it, for the first reason, is insufficient product awareness. And that's certainly, something that's still out there even today in the UK market, for example. And the other reason is the transactions are too big, right? If, the transactions gets into the 30, 40 billion, et cetera, the insurance market just isn't big enough to support that. And on the other side, there may be a perception that the transaction is too small and therefore the market doesn't necessarily have an interest in that. But I think there's growing appetite among insurers to insure the smaller transactions, and that's one of the things that we at Talos are focused on, growing sort of the universe of transactions that's out there that's being insured. And it is an area that needs sort of the brokers out there to sort of raise product awareness, et cetera. And that is one of the things that we are working very closely with our broker partners to do.
But I think
sorry, go ahead, Ron.
I want to jump in here because I thought about this is a great question. Considering but not buying. For me, it's totally clear. For a big PE fund, totally clear. They want a clean exit. They want to return their funds as quickly as possible. They're probably your heavy users. What about the smaller company? Or what are the next biggest users, basically, your biggest customers after PE funds? Sorry, Nick.
The private equity funds are there. I think sort of the entrepreneurs, I think they're seeing a bit more in terms of venture capital. But again, I don't think the value proposition changes if I'm a sole entrepreneur and I'm selling my business. If I can take 1 million, a few 100,000, whatever that number is, that's sort of life-changing money for myself. So if I'm able to take that away or sort of release that escrow when the transaction's signed, or sort of not put money into escrow, take that money, and then the added benefit is the recourse, other than fraud, in the respect of fraud, is the insurance policy. So to the extent there is a breach and that hasn't been fraudulent, the insurance also benefits you as a seller in the sense that it allows you to exit the sort of the transaction.
They'll defend you, right? I mean, because they'll want to defend the claims against the policy. Is that a little bit like, is that a way to think about it, or am I oversimplifying it? Is it like a little like a ex post D&O policy for me having
it does two things, right?
It?
It's a cash release, right? So it allows you to free up capital, and it's also a sort of a safety blanket, a contingency blanket. If something comes out of the woodwork that you had knowledge of, you shouldn't have known about, and it's there to cover that. So it's the benefit is really twofold for the seller in that sense, and giving them a clean exit.
But that makes it actually more interesting for the buy side, right? Because there I would like to have recourse to the insurer. I don't really know what I'm buying. While on the sell side, it's like, well, maybe I'm a little bit sloppy here and there, and I want this. I love this D&O post insurance.
Yeah, most policies are placed on the buy side, and the reason for that is it allows the buyer to have recourse in the event of a seller's fraud, right? So, what you spoke about, the diligence and what's the interplay between W&I and diligence, and I guess I'll pick up both those points now, right? Diligence picks up known matters, right? By default, you can't diligence things you don't know about. Right. So one of the main functions of the W&I policy for the buyer is for them to have insurance in respect to the things they don't know about. And I think fraud is a great example for that. Right. If diligence determines that there's been fraud target level or the the sell side, you don't do the transaction, you've been the transaction. But if you do discover fraud after the fact, your recourse won't be against the diligence. Here you have the benefit of the W&I policy, which will ensure or should ensure any loss arising out of the seller's fraud. So you, buyer, will be made whole in those circumstances. As you said, Ron, you have an ability to go against the W&I policy again, as opposed to the sellers. But the sellers, the W&I insurers will retain subrogation rights in respect to those fraudulent sellers. But again, that's one of the main benefits, is why you see most W&I policies being on the buy side, because that's an additional advantage for the buyer and for the deal parties.
I think you said something interesting in there, and that might counteract my D&O thought. How strong are the subrogation rights? Is it merely on fraud, or how is that being
Yes,
handled in practice?
they are. I would say they are very, very limited in terms of the insurer's right to subrogate. They're very limited, and that's just a function of the competitiveness in the W&I market.
Okay. So because you've mentioned understood that the insurance policy covers unknown things, obviously. When preparing for this, I talked to someone and he said, "Oh God, yeah, we looked at it," and he was actually a PE, and I think they're doing quite big deals, but he was like, "Yeah, we looked at it, but then they were asking even more questions than the Big Four or the consultant. It was so annoying, and we just didn't bother." Because they were even asking more questions on top of it, which just leads me, number one, whether you feel that that's the case, and number two, why did you then just skip the DD part? I mean, I always find someone who can identify and price a risk more interesting than someone who can just identify a risk.
Yeah, no. So in terms of that specific instance, I guess I can't really necessarily speak to that, but I think the W&I market has become very, very adept to providing a very, very smooth, efficient process, on even the largest deal. So obviously everyone's sort of experiences will be different, but I do think the market has really, really adapted there. And interestingly, from my perspective, and I've been doing it for obviously a number of years now, I would say W&I allows the parties to almost enables them to do potentially less due diligence. And insurers, underwriters have actually acted as sort of the gatekeepers, because if you think about it, if you are buying 20% of the deal value in terms of an insurance policy limit, that means you only need to necessarily sort of do 80% of the due diligence, because you have a sort of a 20% buffer or sort of cover for that last 20%. And that last 20% can be quite tricky to nail down, because the insurance picks it up from the ground up. So it does give you a bit of a buffer there. So I think that the two interplay very, very well. And I think that's sort of been the success story of the product over the last 20 some odd years.
Is this where this term I came across again and again, this synthetic W&I insurance comes in, where the warranties are not given by the seller, and instead you have basically detached the scope of the insurance from the negotiations? There's a synthetic set of warranties which is attached to the policy. Is this still a thing? Can I just say, well, I have a broad synthetic W&I insurance and I send the entire DD team, well, not home directly, but you know what I mean. They can take half day off.
No, I would say on a synthetic deal, starting from, I guess, the beginning there, synthetic deals or synthetic W&I policies that ensure a synthetic set of warranties is one of those things that's oft talked about, but seldom done in practice. I've done a number of them over the years. Truth be told, they're probably a bit more difficult in terms of the process there. Underwriters will tend to ask more questions. You have to ensure that the seller has still like engaged in the disclosure process, because at the end of the day, the W&I is ensuring a defective sell side disclosure. So you still need them, and it does. I would say I would describe it as decoupling. It decouples the buyer's recourse from the SBA and embeds that within the insurance policy. So it's very similar to a buy side W&I policy where the seller has capped their liability at £1. And I think most brokers and most people in the sort of the W&I ecosystem would tell a client, unless there's a real reason why you need to do this, then you probably want to go down the sort of the nil recourse route. And one of the reasons why the parties might specifically want to do that is because the seller is sort of unwilling to give warranties. And that might happen where you have a receiver. So out of an administration, I think that was really one of the earliest sort of synthetic policies. If you have an administrator or receiver selling an asset out of insolvency, they just will not give any warranties. So I think that was one of the early reasons for that. You might have a distressed sale where management or the seller is getting very, very little out of it, so they're unwilling to take on sort of this potential additional liability, even if it's very, very minimal. They just won't take it on in any case because they're getting very little out of the transaction. So those would be the two instances where I think we have seen it. But other than that, I think people would mostly say go with the normal structure.
Okay. So if you compare markets, Europe, US, and Asia, I have the feeling that, I don't know, 15 years ago, this was no big thing in Europe yet. However, right now, I have the feeling that just every other deal has some sort of W&I insurance. Can you please elaborate a little bit on this? How big is the market here, and how do we compare with the US or Asia maybe?
The W&I market has grown quite a bit. As I said earlier, I've always been working on non-North American, non-US business, so was underwriting some of the transactions out of Europe for some time. But there's still a lot of room to grow. So there was a market claim study, a very detailed one that was put out, and it said there were roughly 15,000 policies over 8 years, and that sort of works out to 1,875 policies a year. When you look at another source sort of total M&A transactions being done in Europe on a yearly basis, there's 15,000 across Europe being done. So that works out to sort of a 15% market penetration. So there is a huge amount in terms of further work to do as a market to really grow the universe of deals that are out there. There's a significant set of untapped opportunities out there, and those tend to be on the smaller side. Obviously, the bigger transactions tend to skew the value numbers of M&A as opposed to the volume number. In terms of the US versus Europe, which I'm probably a bit closer to and can speak to, I think the Asian market would be smaller than the European market, but I think there's probably around $1 billion of GWP here in Europe versus 3 in the US, so sort of it's 1/3 of the size. But again, I think a lot of that is probably due to sort of rates being slightly higher, or double in the US for various reasons. But in terms of where the market is, that's where I would put things.
Well, what drives this? Is it private equity activity? Is it competitive situations, cross-border deals? What do we have to expect for the future? Will Europe catch up, even though by terms of GWP, we will probably stay behind?
I think it's stepping back for a moment. I think it's important to think about W&I as compared to most other insurances. If you take cyber insurance, right? Cyber growth has really been driven, from my perspective, by the digitalization of everyday life, and increasing risk threat actors in terms of variety and number over the years. So it's sort of it's an emerging risk that's there. where W&I is really, W&I is not a response to an increase in M&A risk, right? It's a replacement for something that would have existed ordinarily, i.e. the seller's indemnification obligation. So when you look at what are the drivers in terms of, volume of deals that are being done, I think what you really look to is localized solutions. So you have brokers and underwriters in country who are raising people's, the relevant parties, awareness about the products. It used to be in the very old days, things would be done from New York and London, and everything would flow through those two sort of centers. But now I would say there's been a significant fracturing of the market where you have, underwriters, brokers, across Europe, in various parts of Asia, et cetera, who are actually building product awareness locally. So I think, in terms of what are the real drivers, from my perspective, it's really product awareness and people being able to provide localized solutions. And of course, one of the key drivers for W&I or reps and warranty is M&A activity, right? Because it's just a function of, M&A. When M&A goes up, so does the number of policies purchased year on year.
Let's talk about claims. So what type of breaches are most often claimed, right? What's in the works?
I think in terms of looking at them, I think the first distinction you really want to make is between severity and frequency, right?
Sure.
Severity is a very, very important one from our perspective. And when you look at an M&A transaction, the thing that drives high severity claims is anything that hits revenues and earnings. Because if you valued something on a multiple, it's going to multiply that loss. If you would valued something on a discounted cash flow basis, when you divide by the discount percentage, it's going to have a multiplying effect. And the things that really drive high severity claims, from my perspective, are things you would expect. Things like breaches of customer material contract warranties. Because obviously, if you have a breach of a material contract warranty, that's going to impact revenues, earnings.
As a non-lawyer, I mean, Ron says, yes, this makes perfect sense. But does that mean like I'm saying I have this really great contract and I don't, or I have misstated my pipeline, or what would that mean in non-legal English?
Sort of all of the above. I think one of the sort of if you take an example, a good example, you may say, I have not breached my material contracts, and it turns out that you haven't, it's a long-term contract, you haven't delivered, the appropriate
breach an SLA or something.
Yeah, exactly, by a certain date. And therefore there's an impairment of that contract. And because that goes into the valuation, it sort of has a big impact on the value that you would derive from that revenue stream.
What are some other, I mean, what are some ways where people, and also some guidance to say, guys, this is not where you want to make it gray. This is where it's black and white. You want to make sure that if there's big contracts and, you're in dispute, I don't know, do they go into depth about, I guess, that I don't know, contract terms are shorter? I don't know. What are some things that people try to hide to make their revenue look better, and other than what you just stated?
I think one of it's an area where there's some sort of, where you have an issue most of the time is where you have some sort of discrepancy between a buyer and seller in terms of how something should be treated. For instance, revenue recognition is a great example of that, right? Some people, the sell side might have some sort of revenue recognition treatment, whereas the buyer says, actually, no, the proper revenue recognition should be, quite different. So that is really one of the key drivers in terms of, I would say breaches around things like key management estimates or complex accounting standards. Those sorts of things to material contracts I would say are probably some of the key drivers of, claims around material contracts.
But I think like AP and like so that stuff or branding, some of the less tangible stuff that might consider or I don't know, is it about like talent or or is that more of a kind of VC way of thinking and an M&A? It's really it's really not so much about the people anymore. You can see if you can't see it in the revenue figures, who cares?
No. So I mean, those are things that drive high severity sort of loss are really around sort of those revenue earnings. But when you say, okay, what's driving frequency,
Mhm.
that's really sector specific, right? A tech business is more likely to have an IP claim than a property claim, right? A property
Sure.
business is more likely to have a property issue than a IP issue. So those sort of things you really have to look at on a sector by sector, basis. If you're heavily reliant on a manufacturing facility and people in that manufacturing facility, that's sort of one risk profile versus, a tech company with, sort of different sort of type of employee. Maybe they're not unionized, et cetera. Building some sort of software product in that space.
Just one. So where do you get then, from an underwriting perspective, your expertise as you'll go across sectors? Or is that just simply like, it's like general liability, it's different across sectors, but you can you kind of know, and you don't need to be a sector expert. It's fine if you're a warranty and indemnity expert, and you'll figure it out, that one is bio, the other one is IP, the other one is property, the other one is whatever.
It's an interesting one. It's sort of it's it's one of the things as I build out the technology with the team and sort of say, and the sort of the tech team says, well, what are the rules? And you say, well, it all depends, right? So one of the things I think it's really really important to do is start with the financials of the company. What are the key drivers? Is it employees? Is it property, plant, and equipment? Is it sort of the assets themselves? And then I think over time, underwriters generally get a sort of a very, very being good, quite good at being generalists and being able to sort of spot liabilities in respect to the different businesses. But it can be quite difficult, especially when you get into very, very complex sectors like healthcare or financial institutions, et cetera. Those types of liabilities are sort of harder to spot potentially than things in other areas that people are more familiar with on a day-to-day perspective, like property, a renewable asset, etc.
You mentioned the specifics of sectors, but just before you also said more often than not, there's a difference in the perspectives of certain buyers, of certain sellers. So I would be interested, does the presence or the discussion of W&I Insurance, does it change negotiations between buyers and sellers? And if so, how does all this also play into your underwriting?
It does, right? I mean, as we all know, insurance changes people's behavior, right? Where a seller is able to walk away with £1 liability versus leaving a significant pot of cash behind an escrow for a number of years. It's not unexpected necessarily that they sort of take maybe a slightly less robust stance on some of the negotiations. So again, it's one of those areas where the underwriters have to be very, very careful of, in terms of making sure that the seller is just not rolling over. They are pushing back on that. But I think the real key thing that you look at from an underwriting side is the disclosure process itself, because that's really what you're focused on, and that's really what's going to drive claims. So you look at the population of the data room, you look at the disclosure letter, are there a bunch of gaps in the due diligence where the buyer has said, I've requested this, but it hasn't been provided. So that's really, really one of the key tests. And the other is the policies and controls that a company has there. If you look at the audited accounts, they look robust. They have a very, very good monthly management account reporting process. Do they have all the relevant policies, employment policies, et cetera, in place. It just gives you comfort that you're dealing with a well-run business, and a well-run business is less likely to have sort of skeletons in the closet or unknown issues coming out of the woodwork than a business which has been poorly run.
If it does change behavior, and we all know there are certain companies in the market who do a lot of M&A, and there might be skeletons in the closet. Do you keep something like blacklists and gray lists? Oh my God, these are be careful with these, like in terms of large companies, not this, hey, I build a family business and I'm selling now because I don't have any kids one time. But these constant inorganic growth companies and the other ones on the other side who sell constantly. Do you look at history?
Probably less so than you would think. I mean, and I think one of the main functions there is it's difficult to know, insurers put out claims data, et cetera, but obviously all this is very, very confidential. There are some things that have made its way into the public, so people might know about those, more broadly. But again, I don't think that's really sort of a thing which many people, really, really focus. I mean, it's something that comes into mind or you think about, but it's not something I would say is sort of overly prevalent. But it's certainly something you think about in terms of what you're doing. And I think the best sort of measurement stick or sort of metric for that is really, figuring out how well the seller has disclosed, how well the business is run. That to me is really probably the most important thing. And when you come across a business that hasn't been run very, very well, and there's lots of gaps, that this data room is sort of not very well organized, not very well populated, that's where things become concerning.
To move over from the product from W&I Insurance to your company and to distribution in general, how is W&I generally distributed? I guess via MGAs, via brokers. But how is there any chance to differentiate yourself from your competition? How do you do this against others?
Well, I would say, I mean, it's two things, right? In terms of how do we compare ourselves against others, right? I think, as I mentioned, we had a very, very positive response from the market. And I think that's because it's genuinely a new proposition, right? We're trying to grow the smaller end of the market and the overall universe of deals that can be done economically, right? And we're doing that through technology. So in terms of comparing ourselves against others, I think it's a genuinely new proposition, and we've seen that a lot of the insurers tell us that and support us because of that. In terms of convincing, brokers to work with us, it's one of those things. You compete hard for the right business, and you do a good job providing service, right? It's a very, very easy thing to say, but it is it's a hard thing to deliver on. But I think those are the 2 points I would really highlight in that regard.
But it's a two-way street. What does a broker have to be your ideal distribution partners? What does he have to bring to the table, and what better not?
I think there are people there are brokers out there who really see an opportunity. I think most brokers see this. If there's an opportunity of an untapped market, and the question is, how do we capture that? How do we service that? And what has been typically a very, very manual, human-led brokering and underwriting process, very, very time intensive, right? So you want someone to see that opportunity, and then you want to find someone who's willing and able to be creative and adaptive, from the current business models to sort of move into this new type of business model, which allows us to trade in a much more sort of economic, efficient way and capture these smaller deals out there.
On that, you mentioned brokers. So I would imagine, what about the kind of wider ecosystem that are sitting on these deals? Lawyers, DD consultants, the PEs themselves, I don't know, sell side, people who advise family business. There's other people kind of flying around this. Do you consider those also distribution partners or influencers? Do you engage with them proactively? How does that work?
They are, so that whole group, I would definitely say, is influencers. In terms of, the people maybe with a sort of a disproportionate influence, I would say the lawyers, for example, are disproportionately influential in that regard. If you took at the DD providers, maybe the accountants, the tax side, I think they're very, very aware of it. They're involved in the process, but I think I would probably put the lawyers above that. I think those are the people that have really tended to bring the deals to the market. But in terms of engaging with the wider ecosystem, especially with what we're trying to do on the smaller side of sort of the deal value spectrum, it's very, very important for us to engage with those people. And we're doing that in collaboration with our broker partners. We're offering tools to our broker partners to say, actually, are there ways we can trade more efficient? Can we do things to get together to help capture this market in a way that makes sense for you guys, but as also makes sense for us?
But why do you, for example, so if the lawyer, let's just say, is so influential, would then the lawyer go to the broker? Why wouldn't the lawyer go directly to you? Or why wouldn't you try to influence the lawyer directly to, I mean, I guess they want a broker for to make sure that you have the broker liability, but just out of interest, how the deals
The,
flow.
the broker plays a very, very important part in that, they're able to go to market and ensure that they receive sort of the best terms from the market. Because what we take here, we talked about, W&I insures a seller indemnification obligation. That's a point of friction between the parties. What they're doing is they're taking that and then they're putting it into a competitive bidding process within the insurance market. So obviously, I would say a broker is slightly better at that, being able to, go through that competitive process than sort of an MGA themselves would be. So I think there's an important part to be done on the education side of it, but I think the brokers play a very, very important part in this chain.
Is this the same for all deal sizes, for 10 million, 100 million, or $1 billion deal?
In terms of the broker?
In terms of the role of the broker, in terms of the importance of the broker, or is there even a sweet spot in deal size? Because that whole thing gets pretty expensive if the deal size is very large, right?
Yeah, I think in terms of, the broker adds, they add value across, I think, the deal values. But in terms of large deals, there's an additional point, which the value that the broker brings to the table, because no one insurer will be able to put up the entire limit. So they're insuring a tower, so insurance tower there, which obviously is quite a lot of work for them. They have to make sure there's no difference in terms across the different excess policies, et cetera. So there's sort of a lot of whipping the insurers, underwriters into shape to ensure that there's a really a good product there for the client at the end of the day. On the smaller side, I think there's certainly value for them, but it's really about ensuring that we can trade more efficiently, reduce the touch points for themselves. Because from my perspective, one of the best things, the most value the broker can do, and the thing that no underwriter or insurer will ever be able to replicate, is their distribution network. So from my perspective, I'd love to hear, see the brokers out there, going out, selling to clients, knocking on doors, et cetera, as opposed to, cutting and pasting things in various reports, et cetera. And because that's not necessarily adding value in terms of growing the universe. Obviously, it's an important part of what they do, but it's, if there are things that we can help them, enable them, I think that's one of the key areas that, we consider looking at.
You mentioned technology quite a few times. So what are some levers in technology that you do? What's bread and butter? What's specific to W&I? I?
'I?" So I think technology, AI, sort of, software, et cetera, has a huge play in insurance. There's a lot to do there. I think some of the things for some of the problems are in terms of the legacy systems and unstructured data. In terms of what we're doing, I think around that, one of the key things we're doing is building sort of a platform which allows us to capture data, right? So, if you think about, a lot of the AI tools out there, that's great. You can log into ChatGPT and do some certain things, but that's not scalable, right? That's not an enterprise ready sort of system. So what our team internally is doing is we are building from scratch a software platform that allows us to capture data, learn from that data, be more efficient, sort of populate and then triage an MBI or a quotation or a submission that comes in, build out a quotation for us, allows us to sort of have actionable intelligence from things that we've previously done. You said this is a troublesome warranty that's come in. This is how you've looked at it in the past. This is how we'll sort of treat it there in the future. So it's very much a human in the loop system that we're building. But obviously you have to build that system with sort of adequate data security. The AI needs to be transparent, traceable, explainable, etc. But it's a really fun.
It's an engineering feat. I mean, you can. I'm sure, and to be fair, if there's certainly a steep learning curve for probably most underwriters just with a enterprise grade ChatGPT license, but that's not the same as writing a process, an engineering process. That's just like a totally different thing. You can conceptualize you and the bot, that's fine, but that's not a system. It's far from it. So I totally get it. And maybe that's a good segue into sometimes I call it hot or not. I think that's from the Facebook movie or something, when he started pasting pictures of students and whether they're hot or not. I believe that's how he started.
That was an app before.
Was that? But didn't he start like? But anyway, I think he even that was like his first version of it. I think he started with hot or not. But anyway, maybe I'm attributing this wrongly. But let's just and again, maybe if you have other ideas that you thought were hot but didn't turn out to be hot, please say so, Jeff. But so one, and I think you've already answered it. It's basically putting in a series of AI-powered interfaces to extract data, to triage, to give an initial assessment, as it's a laborious process. There's lots and lots of documents, and I would assume that's something that you guys do, but might not be as deployed in the market, if I'm correct.
I would agree with that. It is something that we've worked on and have built and continue to iterate over and improve. But it's a lot of hard work. That was one of the sort of the ethos of our firm, i.e., having the engineering team and the underwriting team sitting together, iterating over this project, seeing sort of eating lunch with each other, hearing calls, etc., doing all these things, because there's a lot of cross training that has. The engineers gone out to events with the brokers and the insurers, etc., and they come back. I remember one of the engineers was saying, "What's this reinsurance thing?" So it's just sort of one of those things. And then the underwriters sort of say, "What's agile? What does that mean?" So it's an important thing. That was one of the key learnings, and one of the key things that Anish brought to the table was, because when I initially had this idea, I said, "Oh, well, I would outsource that." And he said, "I've built complex tech software before. That's not how you do it." And obviously, me not being a sort of a engineer software builder, have gone up a pretty steep learning curve on that. But it's an important thing. It's why it's one of our core competencies. So that's why we keep people in-house engineering team doing that, because as you say, it's great. These things you can ask the questions, you can do this, but that's not an enterprise system. That's just it's not there. So it's
no, and I mean it's and there's probably some specific levels of how to drive down hallucination, and it's just a continuous loop. And you'll flag something with another deal will open up another fork of decision which you haven't thought about. I mean, you have, but it wasn't in the scope because you're like, oh no, of course, in this instance, all the other rules don't apply. And you're like, yeah, that's not how you build an IT system. And so I get how that needs to kind of sit together because it's iterative and it will continue to be iterative, especially as you use AI because it's not a deterministic software. Okay, so that was, I think, an easy one. Now, and the reason why I'm saying that, so I sat down with someone, as you might know, there's a lot of buy and build PE plays. What I'm a little bit more aware because it's part of our industry is there's a lot of buy and build in brokers within Europe for sure. And there is, let's just say, the big brokers who want to sell have been sold, you know. So you need to start going downstream. And one part of that that limits and there's a clear PE play, right? By assimilating all of the smaller players, you already, can kind of return that PE fund for that tranche. Now, what you can't do is doing the normal DD process. It's just, what's okay on, I don't know, 10 million of premium for a broker, certainly not okay for a million or something. But Germany alone, I think, has 40,000 brokers. There's like on the smaller tickets. So to cut a long story short, do you see specific products that you could envision building specifically for a buy and build PE strategy so you could move even further down, but intentionally to cut out some of the due diligence, but you kind of skip that part and basically make the underwriting part a substitute for the due diligence and maybe then something on top of it to really drive that down?
No, I sort of supporting, the buy and build strategies of PE firms is something that, the W&I space has certainly done. Obviously, we've done a number of those transactions. So I think you're correct. It's a great sort of form of, it's not W&I isn't a renewable book of business, but buy and build is sort of as close as you're probably going to get to a renewable source. So
semi-recurring.
Yeah, exactly. Semi-recurring. So it's very useful. And it's sort of horses for courses. So someone came to us the other day. They were doing a 400 grand acquisition of some rooftop solar assets. It was probably 8 or so. And they said, all the due diligence is internal and everything's done by, emails. Like, are you going to be okay with this? And I said, yeah, right. You go through the leases of the space, the sort of the power purchase agreements, the condition of the assets, planning permission. You can look at the KPIs and you can sit down and have a discussion with the relevant people. I don't think you want to say you don't have to do diligence. I think you really want to get into, a process with people who are very, very sophisticated at what they've done and can explain why in these specific circumstances, what they have done has essentially, covered off the risk. I mean, this was a asset purchase deal. So they said, we're not going to do tax due diligence. I'm like, okay, well, you're not going to have any tax liability in this type of structure anyway. So it doesn't really matter. So I think it's, when you look at that, it's really, really important to engage with, a sophisticated broker and also a sophisticated underwriter is able to support that process. Because again, you might get into sort of, if you don't, you might get into a process where sort of, computer says no, because you haven't done A, B, and C. Well,
sure.
A, B, and C is not relevant for what we're doing here. I think there's room for that.
I would argue in that setting, it's actually the broker going through the broker won't be successful because the broker won't get this. They're not there. It's the same way that, sure, you have a broker. I mean, Ron and I come from embedded insurance, affinity insurance. Sure, a broker can play some credit card programs. All right. It's pretty plain vanilla. But as you see when you're kind of deeply embedding something and you're basically co-creating a product, you don't need the broker because this game won't be the whole point of this is not to go to market and get a quote on warranty and indemnity. The whole point is to cut out the lawyers, cut out the DD, cut out the accountants, get someone who understands the product but can price the product and just churn it through. And so at that instance, would you then not have to speak directly to the buy and build Or wouldn't that be a potential go-to-market to go to potential buy and build PEs or the let's say the things that they've already built? I could name you 10 in Germany, and just go, hey guys, you have a problem. You need to go downstream. DD is too expensive. You have to do some form of DD, but it still needs to, there's still liability here, right? So let's co-create a process. It's sector specific, and now we can really drive down some deals. I would assume that's what you would have to do to go to market, because I just don't see someone no offense, Aon, Marsh, Willis, you name the works to do this.
That's a statement that is not without controversy, I would say. So there are some quite innovative brokers out there, but I take your point. I think you have to develop a process that works, and in terms of who's going to identify those solutions, though, right? I mean, that's where, going back to what I said earlier, I can see brokers add a lot of value in sort of going out, finding those solutions, and then sort of facilitating a process around that. But it's it's, as I said,
Listening to the two of you, I would like to take Nick's challenge one step further. Doesn't all this buy and build, where you have sophisticated buyers who hate risk, they can't do due diligence, wouldn't that lead to a boom of no seller recourse deals? There's no seller indemnity, or maybe fraud, but that's pretty much it. And we see this already in a lot of auctions, right? Wouldn't we also see this in buy and build? And then we definitely don't need a broker. Then we can actually say, in all kinds of these deals, we take your no seller recourse product.
As I said, from where we are right now, I think the
Jeff is very politically acute. There might be some brokers listening here. Stick to the party line. No, I get it, it's fair. Okay. Have you, just out of interest, is that something, just from a product design perspective, you would say that's certainly feasible to structure? It's just now a question of how we just have a difference of opinion of how to kind of go to market with that.
We've worked with, and again, we've worked with brokers and done a number of deals on this basis, at Talos, right? So, a company was buying, it doesn't do sort of necessarily medical devices, but there's sort of the parts of medical devices where they're sort of doing like tooling of small type of things. One was a CNC manufacturer who sort of, takes those big blocks of steel or aluminum or whatever and carves out things. So, that was something we worked with them on. They went out, they had to do a big sort of client education process with them. So yeah, it is something we're very, very keen to do. And, and we have worked on with brokers.
Cool.
Looking into the future, what will change? I mean, the market's growing really, really fast. Nick just tried to bring back synthetic covers with broad for the buy and build. We didn't completely succeed here. What relevant changes will there be? How will this develop?
From my perspective, I think there's a lot of room to go in terms of growing the number of deals, the volume of deals that are being done. And I think really the thing that's going to change that is really, really going to be around, the technology space. Can you envision a day where, I think this is far, far in the future and, would have to be sort of validated with a lot of data. But can you imagine a place where sort of, this 2-week, whatever long process is can be turned around in, less than a day, minutes, hours, sort of the purchasing decision can almost be, instantaneous. And I think you'll see a lot of sort of work with this in the, the legal tech space as well, how they can make, due diligence more economical, quicker, et cetera, around some of these things. So I think there's a huge amount to be done in terms of making these processes more efficient and more economical. and being able to sort of grow the universe of transactions that are being done out there. So I think that's really where I think the sort of where I can see the real big opportunities in the future. But that's obviously a lot of work out there.
As an insurer, does it still make sense to go into the market, or is there, well, probably not today, but in the future, the risk of saturation, over competition, too many of them?
There's always a risk, right? There's always that risk, but I think it's sort of it's all about providing a better solution, a quicker solution, a more efficient solution, and then going out and competing on that. I think that the key issue that I think you have with sort of the current processes is scaling is very linear, right? One underwriter can do 5 deals, 2 can do 10, 3, right? And as you grow that team, it becomes increasingly hard to sort of monitor quality, making sure there's consistency, because everyone's sort of doing their own little thing. And that's where I think technology plays can have a huge impact in terms of, ensuring, as you scale, that you have a sort of consistent, quality control, quality product moving out. So I think that's what I would say there.
If you mentioned originally, kind of coming back to your introduction, you said you originally wanted to build a multi-line MGA and used warranty and indemnity as a wedge.
Yep.
Is that still the case, or do you feel, maybe, sure, we're all sort of young, or do you just feel, that's 15%, there's enough room to grow, and it's a good product, we're not talking CPI or something like that,
No, we've hired a team of additional underwriters, so we'll bring our second product to market, in several months' time. It's stealth for now, but so we certainly have that sort of much broader ambitions to grow out into these other product lines, because W&I is a very holistic sort of business risk underwriting process. And there's a lot of sort of overlap between W&I and these other products. So it is definitely, our ambition that remains, and something we're already executing on right now.
Yeah, could it seem interesting? Maybe like a follow-on D&O. Seems like something, I don't know.
We will arrange a podcast with the team and how they're going to change what they do with technology, with you guys at the right time.
Awesome. Before we close up, is there any topic that we didn't cover, any misconception that you want to kind of air before we unfortunately have to close a very interesting conversation, Jeff?
No, I mean, maybe not a sort of a misconception, but maybe a sort of a point of emphasis for the the W&I ecosystem in terms of looking where we are at now, because obviously we've spoken quite a bit about the journey that we've come along these years, and sort of claims are up, severity is up in terms of losses. The product is certainly under a microscope at Lloyd's and with the reinsurers and insurers. So I think it's an important thing for us as an ecosystem to consider, sort of what's reasonable for the positions for underwriters to take. What do we think about sort of the adequacy of rates in the current environment, with a view to ensure that this product has a long way to go, and capacity continues to support it. So it's sort of, this is a conversation that people are having and will continue to have, but I think it's an important conversation that we as a group we continue to have. So that would just probably be that's how I would close it off, I guess.
Awesome. Jeff, Ron, thank you so much for your time, and I wish all of you a nice weekend.
Yeah, you too. Thank you so much for having us. Bye-bye.
Bye.